Hey, good morning, everyone. Marty Mazzora, 18th of September 2018. Been, I think, 2 or 3 weeks since I've offered up a video for you. I was thinking this morning that I'd like to share the results of a bunch of back testing that I did over the past weekend of our PWA Index. What you see here on the screen is the scores along with the price of the S&P 500. So what I did over the weekend is I went back to these topping periods and these bottoming periods. This is where the tech bubble burst and we had quite the dramatic bear market. This is where the real estate and mortgage bubble burst and the worst recession and bear market since the Great Depression. So the story would have been or was and still is that here, while the market was near all-time highs, here where it was at all-time highs, general conditions were telling us that odds favored a contraction or a slowdown or a recession or bear market going forward. Therefore, we would have been getting defensive in here, again, as odds suggested that bad times were to come. But notice in here where the market came down in March of 2000 and then rallied pretty nicely for several months thereafter. Our index was scoring a -10. So I think the theme for this morning's video should be investing with a conditions orientation as opposed to entirely a performance orientation. Because if back here, when we were managing money and we started in 1984, or I did, if I were managing it consistent with what I view general conditions to be based on some quantitative measure like we have here, well, I would have begun incrementally getting defensive with client portfolios and therefore underperforming the broader market. So we could have done some, or we would have been doing our periodic reviews and showing real underperformance, I'm sure, because we would have been getting defensive while stocks were barreling once again higher. Here again, we have this peak and a -29. I can tell you that the technical indicators would have been positive because the price was moving with what looked like some momentum. And then it rolled over. And then suddenly this defensive posture we were building up to this point would have been very intelligent looking. It would have looked like smart money management and so forth, but we would have had to live through this period of underperformance. Now, as we meandered our way down, I recall this time quite vividly, in fact, because it was pretty dramatic. We were actually buying stocks in here on the dips. We were rebalancing back to our equity allocation because that's what was demanded based on the strategy at the time. I can tell you with assurance that today, if we have the same scenario, looking at the world with such a focus on macro conditions, absolutely not. We would not be buying equities in here. We would have, however, started scaling back into a more cyclical, more growthy posture in here, just like we were scaling out here. And again, we had some months to go before the market actually bottomed. In fact, this was about a year early. So we would have been, not all at once, of course, we know that already, that markets don't tend to top all at once or bottom all at once. We would have absolutely begun scaling to some extent into the market. Now, as you can see, conditions were still positive, but they deteriorated a bit in here, so we probably would have been very gingerly in that allocation. And even here at the ultimate bottom, we were still a +13, but it wasn't quite as good as we were here. So I don't suspect we would have been super aggressive, but we absolutely would have been moving to a more cyclical posture. Now, a few months after the bottom, that's a hugely positive score, and certainly we'd want to be fully invested. This was a real positive time economically, and it was also very positive for the market. So here we come up, and we're waning a bit in terms of general conditions, but we're still net positive. Therefore, probabilities still favor continued growth in corporate profits. Here we have a +13 at this peak. And then the market starts to contract dramatically. Obviously, we can see here that the macro environment, economic conditions were deteriorating quite rapidly. And therefore, in here, we would have been getting very defensive and we would have missed a lot of this bounce because we would not have had our growthy posture that we had in here. And we would have had this period again a few months of underperformance, but then the market really rolled over hard. Here the market bottomed, but conditions were still negative, so we still would not have been getting growthy. We would have started here 3 months into the recovery, and then along the way, we would have made sure that we caught this nice big rally that we've seen since in U.S. stocks. To bring us to today, on January 15th, we had an exceedingly high score in our macro index of 81. Nonetheless, we had the market fall out of bed. We had quite the correction between the beginning of the year and January 26. So as we declined, certainly the financial markets gave away a bit, but 73 is still historically, as you can see, a very, very high score. So here the market is bouncing back nicely, as it should, based on general conditions. And as you can see here today, this is our latest, this week's in fact, score at 42. That happens to be the lowest score in 2018. And interesting how the market is higher, but the score is notably less. Now, this is a long way from zero. It's a long way from red. So it's a long way from a bear market signal, but it is a deterioration from where we were here. And those of you who are regular readers on the blog know that I attribute most of that decline, or certainly a lot of it at least, to protectionism and to the threat of a trade war and what that's doing at the margin to general conditions. This last week it was commercial and industrial loans that saw a real waning in terms of the growth month over month, and that says something about the general conditions for the economy and potentially for capital expenditures going forward. Again, it's just one data point. There's still growth. It's just slower growth than we've seen. And we also saw rail traffic begin to look like it's rolling over. So rail traffic was a negative in the index. Now, I said earlier when we saw rail traffic take off and truck tonnage take off, in a follow-up with several clients who had asked me about those statistics, particularly truck tonnage, I did say we have to be aware of the fact that at the time, companies were making decisions to get ahead of looming tariffs. So I think we did see a pickup of activity in the first quarter. I think that contributed greatly to that 4.2% GDP print that we got. It was a pulling forward of activity. So we should expect some waning in activity later on in things like rail traffic and perhaps truck tonnage, just because we had such a big surge that it just doesn't make sense that we're going to continue with that surge, particularly now that, as you know, as of last night, that we did get a whole new round of tariffs. And China announced this morning that they're going to retaliate with 60 billion worth of between 5 and 10%. So I'll kind of close with that because you all know that that's my biggest concern, and it was coming into the year. In fact, what I said in the year-end letter and multiple times since is that we were quite bullish, but the one thing that was really going to put our bullish thesis to the test would be a real ramp up in protectionism. And that's what we're getting, but we haven't seen, as you can see here, certainly in the S&P 500, we haven't seen a big rollover in the market. And I would say that's because general conditions are not bearish. We are still in, by definition, a bull market. The S&P is way overweighted with tech. It has more tech today than it's had since all the way back here. And those of you who were with us back here know that this was a disaster for tech stocks. That's the only correlation I can really draw. We don't have a tech bubble today like we did back here, but we do have a somewhat pricey sector. I think there's great prospects for this sector going forward if we don't have a recession. But the prospects for tech continuing to lead the way, I think, are very, very low. I think our other sectors like materials and industrials and financials really are poised to do well if we can get through this trade stuff that's going on. Thank you, folks, as always, for watching and listening, and I'll be back again soon. Take care. Bye-bye.